Have you ever watched a stock increase or decrease aggressively? Have you ever seen price move in consolidation, essentially just barcoding throughout the entire day? Why does price do that? Well, there's a lot of misconception when price moves up that a lot of new traders or investors believe that there's more buyers than sellers, or if price moves down, that there's more sellers than buyers. However, that is a misconception and that is not correct. If I just showed you this picture of pure buying pressure of just straight green bars, or this uh, pattern of straight red bars or straight bearish bars on the downside, why does that happen? And now, what a lot of people or traders might answer is that there's more buyers than sellers, or more sellers than buyers in this scenario. While that's partially true, that isn't the full picture. The true answer to why price moves is the auction theory or the auction process. So, what exactly happens in a auction? Well, let's have a thought experiment. Let's say we have let's say we have this car auction. The guy in the hat is the auctioneer, someone who directs price. We got the masses or like the participants who want to buy the car. And right here I have a graph to represent what exactly happens with the price of the car. So let's say we start off at $1,000. So the auctioneer starts off, hey, anyone at the thousand, anyone at the thousand. And if there's no market participants, what happens is that the auctioneer slowly decreases price until there is an buyer or someone who raises their paddle or something and participates in the auction. So let's say 1,000, 700, anyone 700, and then we reach 500 and we get a paddle raise. So essentially, price goes like that. Start off at 1,000, or let me draw that better. So we start off at 1,000. We move to 500 because there's really no one who participates, and you know, someone, and then once someone uh, participates at 500, everyone starts, bidding up. Hey, can I get a 600? Yep, 600. Can I get a 600? Can I get a 600? Can I have 1,000? And what you'll notice is that you'll get a recovery back to 1,000, and maybe we might go higher, 1,000, 1,500, and now that's a really badly drawn line, but you get the idea. The markets essentially follow an auction where you have participants who drive price up or down. So let's look at this in a more practical sense, like what actually happens in the stock market or in the futures market or the options market, forex, whichever market. Every participant in the stock market, the futures market, or whichever market is classified by two general uh, ideas or characteristics per se, and that is aggressive participants or passive participants. And there's a couple of differences between them. Aggressive can be classified as impatient participants, people who want to get into a trade right now. Passive are those who wait, are patient. They see price action or, a stock news and they believe that, hey, let's wait it out. I have a specific, price target for this, or I want to buy at this price. Now, another difference is their market order or the type of order that each of these participants usually use, or actually always use. Now, we got the market order, which is you basically market in, so you don't really care about a specific fill. You just want to get in and you want to get in hard. Now, the passive is what you call limit order. So you're going to get filled at a price that is specified. So to give an example, let's say Apple is $120. They had amazing earnings, prices moving up. Well, an aggressive buyer would probably, mark it in, hey, let's get to this action, or I want to have a piece of the cake. So let's say price is at $120. What's going to happen is the aggressive, buyer or seller would be filled at 121 or 122. They don't really know, but they get filled at a non-specified price. On the other hand, you have passive buyers or sellers, and the same example, Apple is $120, and amazing earnings. Well, the passive, buyer might say, you know what, I'm actually gonna wait for it to dip and then I'll buy it, and I think a good dip price is 119. So I don't want to get filled at a price more or less than 119. So I'm going to put what's called a limit order. And the limit order has a specific fill. So you put a limit order at 119, you're getting filled at 119. Now, to better visualize this, we have what's called a depth of market. So right here, I have what's called a depth of market. Now, the depth of market is basically a way you can visualize passive and aggressive buyers and sellers, or how price actually moves. So in this ladder of prices over here, as you can see right here, what you have is the price of the specific asset. So I don't know, let's say this is a random futures on like asset. What we have is it's trading at 71, 72, 73, 74, or the price of it is 71 as of now. We got this box, that means the active price is 71. And what you have right here, the red and the green are essentially limit orders, or in other words, passive buyers or sellers. So to give a understanding of what it takes for this asset to go from 71 to 72, we need market orders or aggressive buyers. So let's say we want to get this price from 71 to 72. What needs to happen is we need to have enough aggressive buyers to completely wipe out this limit order. So to give an example, let's say, we got news like right away, and we get 5,123, exactly that amount of market orders. Well, what's going to happen is because all these limit orders are filled at 72, the price moves up one. Price moves up one, and we'll cross this thing out, and we'll have price over here. And in order to go even further up, we'd have to get 218 more market orders to wipe out 73. So to wipe out these sellers, because the market order, they don't have a specified fill. So even though price might be at 71, they get filled at 72. But what they're getting filled into is the limit orders or the limit sell orders from the passive buyers. So the limit sell orders, they get their specified price of 72, while the buyers, they don't get the price that they want, or they don't get the, you know, active price as of now, but the thing is they get into the action. So the same situation, let's say that we want price to move down. Well, in order to move down one, what needs to happen is we need 4,800 sellers, and not just any sellers, we need 4,800 market sellers, or market order sellers, or aggressive sellers. And once we have that, once every one of these limit buy orders gets filled, Well, then price moves down one because this whole thing is crossed out. In order to continue moving, we need 672 market orders, which will be filled at 69, and this will be wiped out. And we have 892, which then will be wiped out. That is how the markets work. You know, we don't have more buyers and sellers. Rather, we just have more aggressive buyers than sellers. We have more aggressive sellers than aggressive buyers, because you know uh, essentially for any market, like online market, I guess you could say, or any auction market, what's really happening is that it's just a race to see who could fill the next block of limit orders quickest. Now this is a standstill image. A real depth of market, or DOM as most people call it, is always going to move, because if you've seen any stock chart, it's always going to be like do 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 do. So this price will always just keep on moving, and it's a very hard skill to master, but this is basically one of the most basic introductions, to say the least, to order flow trading. And order flow trading is basically, what I just showed you. You basically look at how limit orders and market orders are situated in a way for you to enter and exit where you think price will be attracted to, or how the market will be trading. Now, with that being said, let's have an overview. So, as an overview, all markets perform in an auction where price is driven up or down as long as there's participants willing to participate at a specified price. There are, there are two main types of participants in the markets. We have aggressive and passive participants. Aggressive participants are impatient and want to get into a move right now, and so they use market order, which has a non-specified fill. On the other hand, we have passive participants, who are characterized as patient and use limit orders for a specified fill. And finally, we have a visualized system in order to view this auction theory called depth of market, or the DOM. Essentially, in order to price to move up or down, it needs to have enough market participants who could wipe out the next level of limit orders. Anyways, with that being said, thank you for watching and have a good one.